Hello, my friends. Today is January 6th, and this is Markets Weekly. So, this week I want to talk about three things. First, I've noticed that the participation in the Bank Term Funding Program has skyrocketed the past 2 months. Let's talk about why that's likely happening and speculate as to whether or not the Fed will extend the BTFP after it's set to expire this March. Secondly, this past week was Jobs Friday. We got a lot of data on the labor market. The data is painting a mixed picture. Let's talk about what the data is saying and whether or not we're at a turning point in the labor market. And lastly, we got some interesting information from the Fed minutes discussing how QT is likely going to be tapered the same way it was the last time around. Let's talk about the potential path for quantitative tightening going forward and what it might mean for markets. Okay, starting with the BTFP. First, a little bit of history. So the Bank Term Funding Program was unveiled last March in response to the panic in the regional banks. Now recall, Silicon Valley Bank bought a whole lot of Treasury securities and agency mortgage-backed securities when interest rates were low, and as interest rates rose, was sitting on a lot of unrealized losses. The depositors at SVB saw the tremendous amounts of unrealized losses, began to panic, and began to withdraw their deposits. This meant that Silicon Valley Bank had to sell those securities to meet withdrawals, realizing those losses, and ultimately going bust. The BTFP was basically specifically designed to address this problem because it was willing to lend against par value rather than market value. So let me break that down a little bit. So a par value is basically what I would receive from a security at maturity. But it's going to be different from market value because it's going to be discounted through interest rates. So let's suppose I bought $100 in par value in Treasury securities a few years ago when interest rates were low. Now that interest rates have risen, the market is going to discount that par value with higher interest rates, so the market value of that Treasury security is going to be worth less, let's say $90. So today, if I take that security and I sell it in the market, I'm going to get $90. If I go and I borrow against it in the repo market, I'm going to borrow $90. But if I take that security and if I pledge it at the BTFP, I'm able to borrow $100 because the BTFP lends against par value rather than market value. In a sense, the Fed is basically lending unsecured because in that $100 loan, it's secured by $90 of collateral. The last 10 is just unsecured lending. Now, historically, central banks really don't like to lend unsecured. So the BTFP was honestly a pretty revolutionary facility, and it showed the lengths the Fed was willing to go to make the regional banking panic go away. Now, the second thing that's interesting about the BTFP was that the lending rates there were below market. In a sense, it was free money. Now, the BTFP was providing one-year loans. The loan rate was 1-year OIS plus 10 basis points. One-year OIS is basically the market's best guess as to what the path of Fed policy will be over the next year. Now, what's special about OIS plus 10 basis points? Well, historically speaking, OIS plus 10 basis points was roughly equal to interest on reserves. So if you're a bank and you borrowed at OIS plus 10 basis points, you would essentially be borrowing for free. You would be receiving IOR, interest on reserves, from the Fed and paying OIS plus 10 basis points. And historically, those two interest rates were basically the same. So the Fed was basically providing free money to the banking sector. Just one more caveat. So interest on reserves is an overnight rate, whereas OIS is a term rate that approximates the path of Fed policy. So if the market is pricing in rate cuts going forward, the OIS, the one-year OIS rate, is going to be below interest on reserves. But over the length of that one-year term, as we get towards the end of it, the market would have rate cuts. Now, if the market was accurate, rate cuts would have happened, and so interest on reserves would have be below OIS at the time. So at the end of the day, you can think of it as if rate cuts are priced in, that the bank is earning a little bit of interest at the beginning of the loan and having some negative interest income towards the end of the loan. And on average, interest income is zero. Okay. Now, anyway, over the past 2 months, we've noticed a lot of participation in the Bank Term Funding Program. So it's right now, it looks like it's risen to about 140 billion. What's going on? Is it that there's renewed strength in the banking sector? Well, it's hard to say that's the case. I mean, if you look at financial conditions, rates have come down, equity market going to the moon, it's likely due to something else. And that something else is very likely the fact that the market is pricing in a very, very aggressive round of rate cuts this year. So the Fed had penciled in about 3 rate cuts in this year. The market has been pricing in about 6. So in a sense, if you think that the market is being exuberant in thinking of rate cuts, then basically interest rates are too low. And if you are a bank treasurer, well, you're looking at this and being like, oh, that's crazy. Fed's not going to cut 6 times. I better go and take advantage of these low rates by borrowing some cheap money. And it looks like some banks are doing just that. From my perspective, it makes total sense, especially because you can prepay the loan at any time. So if you borrow right now, given that at these low interest rates, and the market actually does, so the Fed actually does cut 6 times this year. Well, at the end of the day, you got free money. If the Fed cuts less than 6 times, well, then you got a really good deal, because your borrowing rate is, on average, is going to be a lot lower than what you earn on interest on reserve. So basically, you got paid to borrow. And if for whatever reason the Fed ends up cutting more than 6 times, you can always prepay the loan. So it's all in all a really good deal. So no surprise, banks are taking advantage of this. I think it's just smart management, nothing else. Now that, again, takes us to the very interesting question as to whether or not the Fed is going to extend the BTFP when it's set to expire this March. Now, to be perfectly clear, financial conditions have eased significantly. There's really no reason for this facility to exist. But on the other hand, this facility has seen increasing interest. Now, from my experience, the Fed is happy to unwind a program, to wind down a program that has no take-up in it. And we've seen them do that with the pandemic facilities. But I think they're going to be a bit more thoughtful if they're seeing a program with increasing interest. So this is ultimately going to be about, in a sense, whether or not the Fed wants to have this extra thing there, just kind of as a extra precaution in case markets become volatile again. It's a really, really close call from my perspective. I'm guessing that the Fed is probably going to lean towards renewing this program for a bit, simply because my read of the Fed is that they are a pretty dovish bunch. But all in all, I don't really think this has a big impact one way or another. Yeah, so we'll see in March. Okay, the next thing that I want to talk about is the interesting employment data we got the past week. So we got 3 pieces of interesting employment data. The first, of course, is the weekly unemployment claims that we get. The second was the monthly non-farm payroll print. And the third was the employment data from the ISM, which is a monthly survey, in this case of the services industry. Now, first, let's look at the initial and continuing claims. So in the US, when you become unemployed, usually you file an unemployment claim with the government so that you can collect unemployment benefits. These are initial claims, and you can see there's nothing remarkable here. Now, looking at continuing claims, you can see that over the few months, continuing claims you can think of it as the stock rather than flow of unemployment claims. So continuing claims over the past few months ticked up a bit, but zoom out a bit and you'll see that it's still quite low historically speaking. Now gets us to the really interesting and really important non-farm payroll employment print we received on Friday. Now the headline obviously was a beat. We created more jobs than expected. But when you look below, it's a little bit less clear. First off, the jobs numbers of the past 2 months was revised lower. So again, that's dampening things a bit. And secondly, if you look at the labor participation rate, it went down a bit. So although the unemployment rate stayed really low at 3.7%, it seems like a lot of it is because there are fewer people in the labor force. That is to say, fewer people looking for jobs. Now, if you zoom out a bit and think about what's happened over the past few years, what we've seen is that there's been a surge in labor force participation where high wages drew in a lot of people who were otherwise not really wanting to work. So we saw a prime age labor participation rate reach levels that were exceeding pre-2020. It seems to be giving that back a bit, possibly because wage growth has cooled a bit. Now, if you look at wage gains, you can see that they're still pretty elevated. They came in higher than expected. So all in all, you have an employment number that, in terms of number of jobs created, seems to be softening, but wage gains still seem to be at an elevated pace. So it's not super clear. Now, the third labor data print we want to look at is the ISM services. So the ISM is a diffusion index. So it asks a whole bunch of companies, compared to last month, are things getting better, the same, or worse? And there's a few different specific topics on this. One of them is the ISM, is the employment question, where they will ask about employment activity. Now, you can see in this particular index, where 50 being things are the same this month compared to last month, you can see there's been a historic drop in the employment component of the ISM Services Index. Now, what that means is that more companies, a historically high number of companies reported that employment activity in December was lower than November. Again, this is a diffusion index. It shows the direction you're moving, but it doesn't show how much. So having a really low employment index print doesn't mean that employment is really low. It just means that a lot of companies reported that employment activity was lower in December compared to November. It's a directional index. It's not a level index. Now, putting everything together, I'm getting a sense at least that the labor market is indeed slowing. Now, at the end of the day, the labor market, like any other market, is about supply and demand. Now, over the past few years, again, a tremendous amounts of fiscal stimulus, we got reopening, so a sudden surge in the demand of labor, and we have bonkers job creation. Again, supply matters as well. Again, at a high level, demographically speaking, our labor force just isn't growing at the same level that it used to, and we have an aging population, so boomers are retiring. So when looking at the supply of labor, it actually dropped during the pandemic because of a lot of boomers retired earlier than expected, but part of that was made up by young people who were participating in the labor force at a higher rate than pre-2020. So again, you had an increase in demand and an increase in supply. Now, right now, it looks like that huge surge in demand is waning, and at the same time, that surge in supply of labor that we've seen is also declining due to lower labor force participation. So going forward, it does seem to me that the labor market is probably going to have softer job creation going forward, in part due to a slowing economy. Again, we were growing above trend. Now we're slowing down towards trend, and the supply of labor it seems to be declining as well. Now, this is actually a really important point for monetary policy. How is the Fed going to read this data? And that's what I'm going to write about this week. I think a lot of it is going to be about the composition of the Fed, and I'm going to look into political donation data and the change in the Fed leadership and come away with an impression that the Fed is probably potentially going to react stronger than expected to this upcoming labor market slowdown. But yeah, I'll write about it this week. Okay, the last thing that I want to talk about is the interesting information we got about quantitative tightening. So this past week, the Fed released their minutes, and in the minutes, there's a section of how QT could be winding down. Now, in the section, it notes that several FOMC participants were thinking that, in our principles, we are going to taper QT, which is exactly what the Fed did in 2019. In 2019, as the Fed was winding down QT, earlier in the year, they announced that, hey, we're going to step down the pace of QT. And they did that over a few months and finally ended it later in the year. Today, QT is proceeding at a historically high rate, a maximum rate of $95 billion a month. It's not actually reaching that rate for a variety of reasons, but that's the maximum rate. Now, going forward, as the Fed is thinking about ending QT, what they're saying that they're going to do is that they're going to taper it. So they're going to reduce the pace of it, let it run for a few months, and then finally end it. Now, tapering QT suggests to me that QT is going to be able to go on for some time simply because they're reducing the pace. So at the moment, the Fed is thinking that the level of reserves in the financial system is really high. And looking at the RRP, still a lot of money in the RRP. So, there's really no sign of a scarcity of liquidity in the financial system. So QT can proceed as planned. But as I wrote about in my piece last month, it looks like they're likely going to be tapering QT probably sometime towards the end of next year if you look at the overall liquidity situation in the market and if you look at the current realized pace of QT. That seems, from my best guess, as to what's going to happen. And if you taper QT towards the end of this year, then you end up with a QT end date of sometime maybe in the middle of next year. But we'll see how that evolves. We also had one Fed speaker this past week talk about how she would prefer to taper QT once the RRP is at a lower level, which actually suggests a faster taper than I think previously expected. But we'll see how that pans out. That's just one Fed president, and right now I think it's pretty early stages, and we'll get more information from the Fed going forward. It's something definitely to watch out for. Now, how is this going to affect markets? So again, a QT that ends sooner is going to be bullish for markets because that means that there's going to be less upward pressure on interest rates. And if there's less upward pressure on interest rates, then financial assets tend to like that. So the financial assets like low rates. But right now, it's not super clear to me if a sooner taper means would be bullish for interest rates, because if you taper sooner, you could actually potentially extend the length of QT such that the overall decline in the Fed's balance sheet is unchanged, just spread out over time. But it's something that I'll continue to think about and write about in the future. All right, that's all I've prepared for today. Thanks so much for tuning in. If you're interested in my work, check out my blog at fedguy.com. And if you're interested in learning more about markets, check out my online courses at centralbanking101.com. All right, guys, talk to you all next week.